afternoon. Well, some traders, as I was just saying that the rand is going to break stronger this week. What's your outlook for the local unit as we kick this new week off?
Hi, Alishia. A very quiet day today, given the fact that it's a London holiday. But I think your lead-in was on the mark. The rand is threatening to break lower, and we need to get below 775 on a sustainable basis to open up further strength. But as you said in your build-up, we're going to have to see further dollar weakness and/or further equity market strength for that to become a reality.
As I mentioned, we're seeing a barrage of economic data out this week, and I want to start off on the international arena here because so much of our own performance hinges on that of the dollar. We're awaiting US ISM data this week. What are you expecting on that front?
Well, we've seen relatively good data coming out globally in the last couple of weeks, showing either stabilization of economic factors or, in fact, a slight improvement. And that obviously has fed through to equity market bullishness, and players now suggesting that the green shoot story of a couple of months ago was justified, and at the very worst we're seeing a stabilization, risk appetite increasing, and as a result emerging markets currencies gaining some attention.
And that in turn painting a pretty bad picture for the dollar itself. But we were talking about this last week, though, where the hurdle to get the markets to adjust is getting higher all the time. So to what extent do you see this challenging the theory that's been lodged at all, even if data does come in slightly better than expectations?
Well, the big question is obviously what happens to the dollar. We've had this so-called quantitative easing. That's simply another way of stating that they've printed cash. And as the global economy picks up, do we have another crisis brewing in the US bond market as they've pumped massive amounts of liquidity into that market, and the balancing act that needs to take place to ensure that redirection of the bond market in the US in fact doesn't create another financial market crisis. So it's quite a fine line that they have to walk. I think the US authorities are quite happy with a slightly weaker dollar. I'm sure they don't want to see the dollar crashing off because that will help them to reinflate their own markets and in fact to pay some of that debt off. So it's not unlikely that the dollar will weaken. However, the other question is if the US comes out of the recession a lot quicker than perhaps Europe and the UK, does that in fact mean that the dollar can strengthen? So that's really the question that the market is asking itself, and as to the future direction of the dollar.
Well, on the local front, we've got credit numbers out this morning. The consumer still clearly under pressure, weak local consumption. The assumption is that this will be fed through to another good set of trade data and a contraction in the CAD. What's your forecast for second quarter data there?
Yeah, it's difficult to call an absolute number, Alishia. I think, again, that call is for an improved current account or set of current account data is not unexpected, simply because, our demand for imports is a lot lower. And resource prices have remained relatively high in dollar terms, and as a result we should see improved trade data going forward, and in fact that should lead through to improvement in the current account data. But I must say that all eyes on international factors, and the international factors far more dominant at this point in time than focusing on domestic economic data coming out.
Well, we've got the G20 meeting from Friday to contend with. Just this morning we had British Finance Minister Alistair Darling saying that Britain is ready to provide an extra $11 billion as part of efforts to increase resources to the IMF, and saying that this should step up efforts to repair the world's financial system and secure economic recovery as well. Has there been any market reaction to that news at all?
Not really. As I said, it's a London holiday, so rather benign market at the moment. But that's the kind of talk that you're going to get out of financial authorities. They're very keen to ensure that the market is the market confidence that is currently prevailing is kept up, and they'll keep talking about if the need arises, that they will continue to feed through stimulus packages and assist the market. So it's really about keeping the confidence high in the market, keeping the equity market stable to in fact slightly positive, to ensure that the confidence remains, because they, as I mentioned earlier, it's really about sustaining the current trends and not to get the market skittish about sort of the exit strategies that will prevail going forward as and when financial authorities need to put those in place.
On the note of not getting markets too skittish, do you see them downplaying the suggestions that we've heard of late of a move away possibly from using the dollar, the US dollar, as a reserve currency?
Well, that's a difficult question to answer. As I said, big reserve holdings in US dollars create all sorts of risks for central bank authorities. If one just looks at China's holdings, they've got upwards of $2 trillion in reserves. It's not very prudent to hold those all in dollars, and it's really about shifting those reserves into various currencies. I think going forward, the talk about a basket of currencies being a reserve basket essentially will gain some traction, because as has been pointed out in the past, to put all your eggs in a dollar basket, creates all sorts of risks.